Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, my guest is Perth Tolle. Perth is the founder of Life and Liberty Indexes, and back in 2019 launched an exchange-traded fund, or ETF, with the ticker symbol FRDM. This was a great conversation. Perth is a rising star in the financial industry. She's an up-and-coming person, and the reason is that her ETF FRDM invests in emerging market stocks based on personal and economic freedoms. Most emerging market funds in the marketplace today puts companies in their portfolios based on market capitalization. Perth's background, she spent time overseas in Beijing and Hong Kong. She wanted to incorporate personal and economic freedoms into her portfolio and therefore omits autocracies like Russia and China. She launched the fund back in 2019. There have been world events since then to where non-autocracies, companies in non-autocracies have done substantially better. You can think of the war in Russia and more specifically in Ukraine as an example of that. And her fund has done quite well. So she joins us on the show today to talk about her investing methodology, how and why she created the ETF, what her journey was like, and what the logistics of launching an ETF really look like from the inside and out. We've had a number of professional investors and fund managers on the show in the past. This was a very cool conversation from someone who had a new and interesting idea, and with the help of a couple of partners was able to bring that to life by launching her own ETF. This is a great conversation, and I hope you enjoy it as well. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. All right, Perth, welcome to the show. Thank you for taking the time and joining me today.
Thanks so much for having me.
So we were just chatting a minute ago. We met 3 or 4 years ago at a conference in Southern California, and you were describing to me what you were working on. You have a lot of experience in finance, and what I remember you describing to me then, this is at like a cocktail party, so my memory might be a little bit hazy. You were launching an ETF that's based on economic freedom. And you described it to me. I thought it was cool and made a lot of sense. But that was in the early phases of your operation 3 or 4 years ago. Since then, you've launched this fund. It appears to be doing well because I see it on TV all the time and just making the rounds in the financial media. And you've just done a really good job of attracting attention to what you're doing. And I'm thrilled to talk to you about the fund, the strategy, and the process of launching an ETF in general.
Yeah, great. Happy to talk about that. The fund is actually both personal and economic freedom. So, we believe that both types of freedoms work together, and we can kind of get into the details there as far as what that means and how we measure it.
So why don't we start here, Perth? Would you be able to just describe a little bit, tell us, what do you do every day? What does your company look like? Tell us a little bit about your professional career.
Sure. So I started in finance at Fidelity in the LA and Houston markets. I was there for about 10 years in the local branches as an advisor. Before Fidelity, I lived and worked in Hong Kong and Beijing. So I was born in Beijing and came here when I was around 9. And then I went back and lived in Hong Kong and worked there for about a year after college. And when I was in Hong Kong, I realized the difference that freedom made in both my life and in the market. So at the time, this was like 2003, 2004, Hong Kong and mainland China markets were very different. There was a lot of excitement about China opening up though. And I traveled to Shanghai and Beijing often while I was in Hong Kong. And I saw the difference that that freedom made. And one of the things that that hit home with me is I had a friend who we called Maggie, who was the same as me in every way, same as all my American friends. We were all around 23, and the only difference is she had no official records. She doesn't exist on paper. So there's no birth certificate, no school records, no social security benefits, no hospital records. She just doesn't exist on paper because her parents chose to register her brother for existence because of the one-child policy. And the one-child policy in China was instituted, the year that I was born, and then it continued for 30 years. And as a result, there are now 30 million missing women in China. And that's based on official Chinese think tank estimates. Some have it as twice that. So that profoundly impacted my generation. And I saw this very clearly when I was in China after college. When I came back, I worked at Fidelity. I had clients who told me, hey, I don't want to invest in Russia. For example, my Russian client said, I don't want to invest in Russia because it's like funding terrorism. And look how prescient that was today. So I started thinking of ways to invest in emerging markets without funding autocracies. I didn't want to invest in China because I kind of saw what was going on over there. I had clients who didn't want to invest in their home countries because of what they know to go on there. But most emerging markets funds were very autocracy heavy. So they had, right now, even there's still, 30 to 40% in the world's worst autocracies in most emerging markets funds that are market cap weighted. And so I created a way to basically have that emerging markets exposure without funding autocracies and also giving the freer countries a higher weight, because we do expect those freer countries with stronger institutions, better rule of law, more individual investor protections to outperform in the long run. So freedom weighting is kind of our answer to market cap weighting in emerging markets. And that's what we do.
Interesting. So tell me more about how the freedom weighting is built.
Yeah, so we use third-party freedom metrics from the Cato Institute and the Fraser Institute. And these guys are completely independent think tanks that don't take any government grants from any government. So we all know about the World Bank controversy from a couple years ago when they had to basically cancel a report that they've done for years and that we actually used at the time, the Doing Business report, because they took money from China and were coerced by China to kind of mess with the scores. So it was important for us to use completely independent think tanks and third-party quantitative data. So that way we have complete third-party objectivity on the data. We don't score the countries at all and we have no influence into the country scoring. So once we have their data, which they use 79 different variables for both personal and economic freedoms, and I categorize them into 3 categories: civil, political, and economic freedoms. So civil freedoms are things like terrorism, trafficking, torture. Women's rights fall into these. Things like missing women metric would be under this category. Political freedoms are things like freedom of speech, media, expression, religion, assembly, internet, and so forth. Civil procedures and criminal procedures, independent judiciary, and so forth. And then economic freedoms are things that we're all more familiar with. So taxation, rule of law, business regulations, freedom to trade internationally, sound money, private property rights, intellectual property rights, individual and investor protections, and so forth. So all of these things added together, there's 79 different variables that they evaluate. Once they have the composite score, we then use the composite score in our system of turning those into country weights. So our country weights come from the composite score, which is an equal weight of all 79 variables.
Interesting. Okay. So I understand exactly what you're saying. That was a great explanation. Is it okay if I summarize that in some less technical terms for our listeners? So for by and large, most people, if you want to have exposure to emerging markets, the first stop might be a cap-weighted index fund. And this is a topic we've covered on the podcast quite a bit in the past. Cap-weighted means you take this whole universe of companies, you multiply the number of shares that exist by the price at which they trade. That's the capitalization of the company. a cap-weighted index takes all those companies and ranks them by capitalization. And so because of that, because that's the way that the list is built, you wind up with a lot of companies in China, you wind up with a lot of companies in Russia. And what you're saying is that you have a different methodology for building the list that's based on personal and economic freedom. And
Yes.
so we're abandoning countries that don't pass certain tests because the third-party vendors you're using to pull the data to build the list don't entertain any of that stuff. So could you describe again to me how you come up with country to country versus company to company?
Yeah, so we do our freedom metrics on the country level only because institutions and governments are best positioned to protect freedoms. So individual companies have very little say about personal and economic freedoms in a country, such as like intellectual property rights, private property rights, freedom of speech, media expression, and so forth. So that's done on the country level, and I think that's something that differentiates us from the ESG strategies that are out there that just look at the security level. So in our industry, mostly ESG is on the security level, but in emerging markets, you have to first have the foundational country level metrics before you can talk about security level. Because if you don't have the basic rights like, speech, media expression, you don't have any kind of third party independent verification on the data that comes out from governments and from companies, because nobody is allowed to contradict it. So without that third party verification, that data is less reliable as a metric of impact in either ESG or non-ESG data. So first, we believe you have to have that country level metric in place, especially in the emerging market segment, just because there's so many autocracies in emerging markets. It's basically half autocracies and half, freer countries and countries coming out of autocracies. So with that type of a universe, you have to first get the country level metrics down to have that foundation for growth and for reliability of data.
And I was looking at the holdings of the fund. It looks like the top country represented, is it Argentina or Chile?
Yeah, currently it's Chile. And that's an interesting, I'm glad you brought that up, because that's not because of their freedom score. It's just because Chile so far outperformed all the other emerging markets this year that their relative performance pushed them to the number one holding. So the freest emerging market at the time of rebalance was Taiwan. So Taiwan at the time of rebalance, which is in January, was the top holding. But now Chile is the top holding. We're, in mid to late October now. So we're going to rebalance again soon in January. And I would expect Chile's weight to decrease at the rebalance because they're not the freest emerging market. They just were the best performing emerging market this year.
Sure. So reconstitution and frequency of reconstitution is a topic I'd love to get into here in a few minutes. Once you get the country weights that come directly from your third-party sources, how do you choose the securities?
Yeah, so on the security level, and this is a strategy where our feedback before we launched from potential investors was freedom is your main innovation here. If we wanted other metrics, like if we wanted value or anything else in there, we could get a value fund in the emerging markets elsewhere. So focus on freedom. So what we did is we stripped out every other factor and we isolated the freedom factor for this product. So there's nothing else on the security level besides freedom related factors. And the only one on the security level would be state-owned enterprises. So we exclude state-owned enterprises on the security level, and then we take the top 10 largest, most liquid securities in each country. And that's just to get a good representation of the country.
By capitalization.
Yes, that it is by market capitalization on the security level within their freedom-weighted country weights. So first we have the freedom-weighted country weights, and then we, staying within those weights, market cap weight the 10 largest securities in that country. In most of these countries, that's going to capture between 85 and 95% of the market.
I see. Interesting. And like any good entrepreneur, you're not pulling that methodology out of a hat. You asked some of your potentially biggest clients about what they want and how they would do it, and that leads you to structure it that way. Okay. So there are roughly 100 holdings in the index?
Yeah, so this year there's 11 countries. Normally there's in the past been 10 countries in the past 3 years. So this year there's 11 countries, so there's 110 holdings this year.
Why cut it off at 110?
So we don't cut it off. We don't cap the number of countries that's going to be in there. It's just the nature of the methodology will always end up with around 10 countries because of the number in the universe and their scores. So we first take the emerging markets universe. That's basically the same as everybody else uses, like MSCI universe. It's 27 countries. And then I exclude the ones that are not large enough or liquid enough to hold, to be tradable in a fund. So for example, Peru is pretty free, but it's not liquid enough. Czech Republic is pretty free, but it's not big enough. So we have to keep it a very tradable for an ETF. So then we end up with the eligible universe, which is about 18 countries. And then depending on the distribution of their country scores, some will be eliminated in the freedom weighting process. And so it turns out this year that 11 were included and 7 were excluded. And so out of those 11, then we freedom weight those according to their freedom level. So the highest freedom country gets the highest weight.
Right. Okay. That makes sense. Yeah, it seemed like a surprisingly low number of countries, but in the emerging markets, a lot of them are simply not liquid enough to include in such a universe. That makes sense.
Even if you look at like market cap weighted emerging markets indexes and funds, there may be a lot of countries included, but the ones that have more than 1% weight, it's going to be around the same number.
Right. Yeah. Okay. Interesting. So how has the fund done? When did you launch and how has it done?
Yeah. So, I mean, it's been fun only because we've outperformed, right? So we've had some extremely extreme events. So we've had, right after we launched in 2019. COVID happened in 2020. And then the China tech crash in 2021. And then the war in 2022, right? So because of all these very extreme events in the emerging markets space, mostly affecting the very unfree markets, we've seen a lot of outperformance. If you look at the 3-year or since inception, there's very strong outperformance. But I would not expect that every year. I didn't expect the thesis to play out quite this quickly. And I don't think that we should expect that going forward. I think it's designed to be a very broad emerging markets exposure with a freer country set. So there should be outperformance in the long run, but it doesn't always play out in the short term. So I don't want investors to get like complacent or think that this can be expected every year. We've had some very extreme events. When Russia got marked to zero, for example, when China had their tech crackdown, those are very extreme events, and those are we're still seeing the ramifications now. But part of our thesis was that freer countries would have more sustainable returns, and we saw that. We also predicted that they would have better recoveries and faster recoveries. And we saw that very clearly in the recovery in 2020. So if you look the second half of 2020, freer emerging markets outperformed broad emerging markets ESG, and emerging markets ex-China. So it's not just a China story either. So we've been fortunate to see all these things play out very quickly here after the launch of the fund. It's been 3 years now, and we are still enjoying outperformance. So it is persistent outperformance. And, I'm happy about that. But just don't expect this stark of an outperformance every year.
How much of that outperformance can you attribute directly to the war in Ukraine? Because if you have some funds that have any exposure to Russia whatsoever, and I can't remember off the top of my head how much Russia is represented in the MSCI.
3% and 4%.
3 and 4%?
Yeah.
So that's an immediate 3 to 4% bump to any fund that doesn't have any Russia holdings, such as yours. That must have been a huge benefit.
So that was a huge boost to us, relative performance wise. But the thing is, when that happened, so late February is when that happened. March is when every fund marked it to zero. And that's when we saw our biggest inflows into the fund, but not because of Russia. It was because of China, because people saw, okay, this happened with Russia. Who do we expect this to happen with next? And I think they saw that China, having at the time about 34% exposure in their emerging markets funds, was a huge tail risk. And so that's when we saw this autocracy risk become a thing. And people started being more aware of it. And, that's exactly what we created this fund for. So that's when we saw the inflows. But I think the inflows came in also because at that time, we already had seen a lot of outperformance. So the outperformance wasn't just because of Russia. A lot of it was also because of the China crackdown over the last couple of years, and also the faster recovery in emerging markets that are more free after COVID.
Right. It's interesting. How large is the fund at this point?
It's about 200 million.
200 million. Okay. So tell us a little bit about ESG. There's been this trend toward ESG, standing for environment, sustainable, and governance positive companies over the last couple of years. And there's been a lot of, one way to describe it might be noise or nonsense in that. You have some fund managers and companies that are kind of clamoring to claim that they're ESG friendly when they're really not, or they really have, stuff that you would expect to be omitted. And then on the other hand, so there are a lot of investors around the world that are interested in investing their savings, their dollars in that manner. But then on the other hand, from a methodology standpoint, yes, it's reasonable to think that if you have positive ESG characteristics, you might be more likely to outperform. But when you omit the companies that don't, those are still super profitable companies that you're not incorporating into the portfolio. So I'm curious how you think about this in light of the index that you've built and maintained through the ETF, and what you see in the landscape right now.
Yeah. So as far as ESG, we've actually tried to distance ourselves from emerging markets ESG strategies that are cap weighted, just because ESG on the security level, as I mentioned, in emerging markets is really somewhat useless if you don't first have the country level metrics in place. So if you ignore country level governance and social factors or environmental factors, but you have security level, that security level data isn't reliable enough to measure the impact of your investments without that independent verification on that data, which may not exist in some of these emerging markets, right? And ESG is also a talking point that is used by dictators to give legitimacy to investing in their own countries, because any dictator can claim ESG, right? How many times has China said they're the world leaders in ESG, and they're literally the world's worst polluters, right? So, and there's genocide going on besides other issues, it's human rights issues. So, it's a very dubious claim that, but dictators can use to kind of further their own interests by using this ESG claim. If you look at ESG products in the US that are in the emerging market space, for example, ESGE is the iShares ESG Aware Emerging Markets Fund. In their investment brief, they say they can not deviate more than 100 basis points from their parent index. The parent index is a non-ESG cap-weighted index. So by their own definition, they have to be brainwashing. Not brainwashing, greenwashing.
Greenwashing.
That too, but no.
Kind of brainwashing, yeah.
Be greenwashing the fund. So it's a kind of a bit of a joke, right? So you have no alcohol, tobacco, gambling, but genocide is perfectly fine and war is perfectly fine. So they had just as much Russia as their parent index, just as much China, because they can't deviate more than 1% from the parent index. So that's why we try to distance ourselves from ESG, the way the industry currently defines it. However, we are looking at human rights and personal freedom metrics like disappearances, torture, trafficking, women's rights, freedom of speech, media, religion, and so forth. Those are absolutely in the spirit of ESG. So we kind of think we're like ESG by default or in spirit, but not the way that the industry defines it.
Yeah, I would. That's similar to my observation. The way that the industry defines it is kind of going off the reservation these days, and I think it's a helpful marketing spin for fund companies and a lot of managers, but it's losing its meaning in its current form.
Yeah, and I think there's some very healthy pushback on that right now, and maybe that will help us get back to where it was supposed to be to begin with. What I found is that what I've observed is that people that work in ESG in the industry are true believers for the most part, and they truly want to do good in the world and make a positive impact. And so I think the pushback is welcome even by ESG proponents, because they're like, well, are we really, missing something here? And could it be better? So I see a lot of that, the good intentions going on in the industry. So I think all this pushback is going to maybe help us get back to the right place as far as ESG goes.
Yeah. Hopefully so.
Yeah.
So I'm curious about the mechanics of launching an ETF and how it's gone for you. Could you walk us through the life cycle of this thing? How, what steps did you take? You had this idea while you were probably still at Fidelity, right? Where did it go from there?
Well, the seed for the idea was planted pre-Fidelity. So it was when I was in Hong Kong.
So you've been ruminating on this for a long time.
Yeah. But I think at the time I didn't even know what an ETF was. So I didn't start the company until years after I left Fidelity. But yeah, it was always in the back of my mind. When I met you, that was 2018 in Dana Point, I think would have been. And so that was pre-launch. And I think it was at that conference that I met Kathy Wood for the first time. And, got a lot of inspiration from people like her. And but really, starting an ETF is a very fun process. It's nerve-wracking also, but I do, coming from the other end of it, I do recommend it for anyone that has an idea that won't let them go. So, this was an idea that just basically pummeled me. And, I didn't care if we were, everybody's like, oh, you can't compete with iShares or whatever. I didn't care about competing with iShares. I just wanted this to exist. I didn't care if we were number 500 in the, market share. It just had to exist, in my opinion. And so, I decided I'd rather try this and fail than not have tried it at all, because this product, in my opinion, needed to be on the market, and I wanted to see how the market would respond to it. So, one thing that helped is I had a great seed investor who became, an investor in the company itself. In the very beginning, I wanted to license the index out to, iShares or Vanguard or Invesco, whoever would have it. And I talked to everyone, but no one wanted it. So I had to launch it myself. And when I decided I had to launch it myself, that's when we started raising funds. As you know, an ETF costs about $250,000 a year in operating expenses. And so we had to raise for that. And Rob Arnott became our first investor in the company.
Oh, really?
Yeah. So that's why we were able to launch the company. Rob now owns 10% of Life and Liberty indexes. So that's kind of the story of how we began, and how I met Rob is a whole other story. We met on a seaplane on the way to a fishing camp in Maine, something I couldn't have orchestrated. And he was there just that 1 year. And so a lot of things happened like that, that made me realize that, man, this idea, it's bigger than me. And it just has to exist. And so I'm just fortunate to be in a place where I get to do it. So I'm very grateful about that.
Interesting. Can we dig into this a little bit more? You mentioned that you first went to iShares, you went to Fidelity, you went to all the fund managers to license the index. So what proprietary rights over the index did you have at that point? You were trying to sell this methodology. Hey, I've got this list of securities and methodology for managing the list. You can use it in your own funds, and you pay me a fee for that, right?
Yeah. So when you license, so I don't know if you're familiar with Research Affiliates or Rob's company, but basically that's what he does. He licenses indexes to be the basis of investment products. So that's what I wanted to do, is license out the FRDM index to be the basis for an investment product like an ETF. And it was always designed for an ETF. So I, talked with ETF issuers mostly.
And if I can interrupt just for a moment,
yeah.
this gentleman, Rob Arnott, did a lot of the foundational research in factor investing.
Yes.
In his company, Research Affiliates, their license is to the Schwab funds, right?
That's one of their licensees.
That's
Yes.
one of them. Okay, so the Schwab funds, the way the genesis of their list, the securities that are put in there are coming from this gentleman Rob Arnott's
It's
work
coming
in
from
his
research
company.
affiliates indices. Yeah.
Yep. Sorry to interrupt, but
So
I had to.
no worries. And so, that's how index investing works, is that a fund will follow an index. Just like S&P 500, you can't just invest in the S&P 500 index. You have to invest in the S&P 500 fund, which follows the index. So that's what I wanted to do in the beginning. And I talked to all the issuers. I did not talk with Fidelity because I already knew that it was too political of an idea for them. Having worked there, I just knew that. And so I did talk with everybody else though, just about, and basically no one wanted it, or if they did, made me a terrible deal, or the deal fell through last minute, or all of the above. And basically it didn't work out. And so one day I was just like, hey, Rob, I'm going to have to launch this on my own. So if you're still interested, I don't know how to fundraise, but if you're interested in, being a part of that, that's a conversation you'll have to have with me. And he did. So, thanks to his foresight and believing in this idea, we were able to launch this product in 2019.
And so walk us through that. You mentioned $250,000 in operating expenses to launch an ETF.
Mm-hmm.
Walk us through what those costs are and how it works from there when you decide to launch it on your own.
Yeah, so 250 is kind of like the operating cost only of the ETF. It doesn't cover your own salary or marketing or anything like that. So usually I would recommend if you have an idea and you want to launch an ETF, that you have at least 2 or 3 years of operating expenses, just so you have that runway. Because as you know, we don't know how the market's going to go. We don't know what's going to happen. When COVID happened, I literally didn't know if we were going to survive. I was like asking my friends for loans, like, hey, anybody want to give me a loan? And I think the Templeton Foundation, I know Lauren Templeton, so she was like, hey, you should talk to Templeton Foundation. And I did. And they were like, why are you asking us for a grant? You're literally a for-profit company. And so I was like, oh. So, and then the recovery happened and we, more than survived. But you want to make sure you have that cash runway so that you don't have to close the fund prematurely, because that's the worst thing that could happen, is a fund that's going to take off, but never gets a chance to, because there wasn't enough cash runway.
Mm-hmm.
So you want to first have that 2 or 3 years of cash runway in place. And probably you want to include, your own expenses as well, and just try to keep the operations lean. I didn't have any sales team. We still don't have any sales team. There's no wholesaling that's ever gone on. We only respond to inbound inquiries, and that keeps us busy enough, more than enough actually. So we're fortunate to have a product that really resonates with people. And that, I think, is key, is the idea something that the market will resonate with, and you will know that within 2 or 3 years. So first have that 2 or 3 years of operating expenses in place, and then just have a plan for how you're going to tell people about your product and make people aware of it. And for us, there's 2 parts of this that I feel like were important to our success. One is, because we didn't have a sales team, I knew I had to do whatever the most scalable thing was possible. And for me, that was, since I only had one person, that was talking to media. And so I just went on every media that would have me and talked to everyone that would listen, and told the story. And if people wanted to come on board with us, we had the ETF. It was very easy for them to come on board with our mission. The second thing is your messaging, right? You need to decide how you're going to do your messaging, and every fund is going to have a different message. Now, with a freedom theme, I could have gone out there and appealed to outrage very easily. But I decided early on.
I was going to mention that.
I decided early on that I didn't want to do that. Whether it wasn't my style, which I discovered later on it wasn't. But at the time when I first started, I didn't know what my style was. But I just decided I'm not going to appeal to the worst side of people to sell this thing, because freedom is not that. Freedom is a word that gets misused a lot and thrown around a lot by people selling outrage and appealing to anger and the darker side of folks. And I didn't want to do that. And so I decided early on that's not my style. I wouldn't sell the fund that way, and I didn't have to. So I'm really happy with the way that we've kind of told our story and gotten the message out there. And I think that, even without appealing to outrage, that we have been effective in the sharing of our mission.
Well, your marketing materials are positioned properly. And for those of you just listening to us, I'm looking at Perth, and then in her background, she's got a piece of paper with the ticker of the ETF. It's FRDM, unsurprisingly, and you have pictures of the Statue of Liberty all over the place, which is the right positioning for this thing, I would say.
So that's our listing certificate, right? So we're listed on SIBO. So when we had our fund first list, there's a listing party. So these are items from that event. So I just kind of took it home, and now it's my background.
Nice. Yeah. So our listeners are not financial industry folks for the most part. Most of our clientele, the financial planning firm, are business owners in various industries that don't pay a whole lot of attention to the nuances of launching an ETF. And I've spent a fair amount of time on the podcast talking about the differences between mutual funds and ETFs, and what the ETF is. It's just a list of securities they're getting from some other provider. Walk us. I want to dig in more into this whole launching process. You've got $250,000 of operating expenses per year minimum, not including your own compensation. You definitely want to have a couple years of those operating expenses saved up before you launch, because you don't want to have to shut this thing before it gets any momentum, right? Yep. So what do you do first? You have some cash saved up. You go see an attorney. You probably form the company. What happens next?
So you form your company, and then you have several options. One is what I was trying to do in the beginning, which is license out the index, right? So you license out the IP. Another company takes all the financial risk and launches it.
And the IP is what kind of IP rights do you have?
So in this case, it's just the index. And I did have a provisional patent on the methodology at the time.
Okay.
But everybody does that differently. So some people have nothing. Some people have, full on patent. Some people, it just depends on your system. And then some people are active. So they are the IP, right? So then they don't need anything.
Sure.
So
meaning, just for our listeners' benefit, they're active, meaning there's a human being making the decisions of what to buy and sell, what to include in the list. And that human being is the intellectual property, because the list and the methodology cannot be ripped off by another company, because that person is not communicating that in advance.
Right. So you can either, the two options left is you can either launch it yourself. So you become an RIA if you're not already. That's the, SEC regulated entity. And then you launch the fund, or you hire a third party, like a white label, to launch the fund for you. That way you don't have to do any of the RIA stuff, the regulatory stuff yourself. They quarterback all the services, and they do all the trading and all of the, sub-advisory, all of that for you. So that's what I did, is I hired a third party white label called Alpha Architect. And I was actually their first client. So I talked them into doing this business, although Wes, the CEO at Alpha Architect, will tell you that it was his idea. No, it was actually my idea. So
Wes, for our listeners, is another industry guy who's like one of the smartest human beings on the planet. PhD, right, from University of Chicago. Yep. He was like was it Navy or Army, or he's a military guy, right? Marines. Yeah. It's incredible human being. The fact that Perth got this launched with his help should be, a badge of honor, because that brings the whole fund a lot of credibility. Yes.
So now he does it for like 20 other people. And so that's the route I chose. And he's been an incredible partner throughout all this, and still is now. So I just learned so much from him. And that's the way doing it that way frees me to just be the, marketer and promoter of the fund, and do our sales and things like that. So I talk with advisors, I talk with media, and I focus on that aspect. And then all the back end operations, Alpha Architect does.
Very cool. Very cool. When are securities actually purchased for the first time? When is it listed on the exchange? And how do you involve authorized participants, which are pivotal in the operation of these things.
I mean, the beauty of the ETF industry is that all of these things are very public and very it's shared, right? So the plumbing is the same whether you have FRDM or whether you have iShares, emerging markets. I mean, it's all the same plumbing, no matter how big or small the firm is. And so the authorized participants, there's about 12 of them that everybody uses. And, we use all 12 as well. So, our lead market maker is GTS. And
Gotcha.
so, everybody basically just uses the same ones. If somebody wants to be an authorized participant in your fund and they're not already, then they just basically fill out some stuff and apply. The more authorized participants, the better, because it just makes sure that investors get the best pricing, best deals. As far as when the fund is listed, I mean, you choose that. Once you have the fund registered, it takes about 60 days for it to become become approved by the SEC. All of these details, it's really best to talk to someone like Wes about. So if you have questions about that, let me know and I'm happy to make an introduction. But basically, that's all regulatory stuff that's determined by the rules, laws in place. And once your fund is approved, then you can launch it. I believe you have like several months to a year before, if you don't want to launch it right away. But most people just launch it right away. And you decide which exchange you want to use for listing. I chose SIBO because I knew Laura Morrison, who was at SIBO at the time, from the time that she was at NYSE. And when she was at NYSE, she showed me around the floor of the exchange, when I was just first starting out, and just was very supportive and helpful to me when I was first starting. So even though she moved to SIBO, I ended up following her there to do the listing there because she had been so supportive along the way. And also SIBO doesn't do, they don't do listings for stocks. So that was something that I wanted as well, because I knew that there were some very autocratic markets that I was going to exclude, who may not like what I'm doing, who have a lot of listings on NYSE and NASDAQ. So I never wanted that to become a conflict of interest and for somebody to coerce NYSE or NASDAQ against us. So that's why I chose SIBO as well.
Interesting. That makes a whole lot of sense. So the fund is reasonably priced from my perspective. I was looking at the expense ratio. It looks like it's 0.49%. Did I get that right?
Yes.
How do you set that level of expense ratio? What are you thinking of as in terms of a business decision there?
Yeah. So again, when I went into this, it was very missional for me, and I just wanted the product to exist. I wanted investors to have access to this, and I wanted them to get the best deal they could. And we actually use local exchanges, so local shares for about 80% of the fund. So if a security has both a local listing and an ADR, we choose whatever's more liquid. And most of the fund is local shares, which means we are paying the custody costs in each of these emerging markets. And that's an extremely expensive cost. So that's why emerging markets funds cost more than, say, S&P 500. Right?
And if I can interject just for a moment, you mentioned ADRs. ADR is an acronym, stands for American Depository Receipt. If you're a corporation in another country, you can list your shares through an American Depository Receipt, and people like you and me and Perth's ETF can purchase the shares in the local markets, which is far less costly. And so what you're saying is that you go with wherever is more liquid because that preserves better pricing for investors.
Yeah. So, or because the liquidity will add to the lower spreads, which will give investors better pricing. But yeah, we just want to keep it very liquid and very tradable. And so that's just, the methodology. So I'm actually very proud of the fact that we pay for this access for investors, because investors on their own is very difficult for any individual investor to get access to local shares in all of these markets. Or if they can, they shouldn't, because it's just such a pain. So that's one of the huge benefits of an ETF for emerging markets to begin with. But also one of our biggest costs, but I'm very proud to pay that for investors. And one of the reasons we priced it this low And it's actually it's average for emerging markets funds to be priced at about 49, 50 basis points. So that's very average. And for a smaller firm, we did have to make some sacrifices in the beginning to do that pricing. But I was happy to do so because any higher expense ratio and you're becoming a drag on returns, right, or more of a drag on returns. So that was most important to me because that's the most important thing for the client is the returns. And also Rob, when he had that conversation with me about, I will invest in your company, but I have these conditions. And one of his conditions was keep it low cost. So Rob also, having had a lot of experience in this business, that was important to him. Being my biggest limited partner, it became important to me as well. So we agreed on that, and that's the reason we priced it the way we did. And I'm very happy with the pricing. I do feel like it's very fair.
Interesting. Yeah, that makes a lot of sense. So looking back on it now, you're launched, I'm sorry, you said in 2019?
Yep. May of 2019.
3 years into it, what would you do differently in those first 3 years looking back on it now?
You know what? I don't know if things would have been different if we had a sales team, if we had a distribution. So, or if we had professional PR for the whole time. I had, PR for the launch and I sporadically along the way. Or if we had just more people and going to different channels. Now, we have been fortunate in that, even though we don't have, for example, a head of, national accounts, we've had people from, family offices, from Morgan Stanley, for example, is the most recent one, basically asked to have us on the platform. And then we get approved on an exception basis. Usually with Morgan Stanley, you have to pay quite a bit of money. This may not be public information to be on their platform, but we didn't have to do that because we have that customer demand and that retail demand from our end clients basically built this fund, and I'm so grateful for that. And I think there are a lot of things we could have done differently, and we could have had more partnerships. Could have had more sales team, obviously. But those are things we can still do now. So I think in the beginning, I would go easy on your, what could we have done differently, and just do it. Just do whatever you can do. The only thing you can see, if you're working with mostly business owners watching this, and they know sometimes you can't see the whole future. You can only see the next step, and you just got to do the next best thing. And that's really all that's required and all that's needed. And so eventually the big picture will come into view. So I don't know what I would have done differently. I think I'm extremely fortunate to have had a partner in Wes, a partner in Rob, and I'm really happy with the way things turned out. I guess I don't know of anything. I think I actually would have involved my kid more in the travels. I should have taken her with me to more places. I think she's getting older now. She's going to be 12 soon. And I think I've been reading a lot after the pandemic, I think a lot of people are reflecting on the importance of, work-life balance and, family and all this. And in the beginning, I started very slowly because I, had a young child. But now I think after the pandemic, people are incorporating family and work like they never done before. And I think I want to start trying that going forward. But other than that, I'm just really happy with the way things turned out.
Well, you've done a really good job at it. What's next for you? Do you have any other funds that you're going to add to the menu here? What are you thinking about in terms of the next 5 years?
We do have some in the pipeline. We have also other markets in the world that are asking for an FRDM product. So we are looking at expanding to different markets versus just expanding the product line. So there's different ways in which we could expand. There are a lot of people that approach us now for partnerships, and we are evaluating, several at the moment. It's very difficult to choose between those because you can't have 10 partners. You typically will end up with 1 or 2. So that's that's the challenge currently. But those are good problems to have. And I have very good advisors. So we'll see. We'll see what happens next.
Frontier markets, is that a possibility, or are those by and large
Frontier?
is that uninvestable for you, or is that a possibility?
You know what? We will try to solve that, because Frontier, the problem is it's not tradable, right?
Yeah.
But it's an extremely fascinating universe, and there are some extremely free markets there.
Right.
So I am very interested in pursuing a frontier market product. That's going to be like more of a passion project, because I think I'm happy to hear that you're interested in that. I think most people don't have a frontier allocation. So it's only the people that are very passionate about like frontier emerging markets or freedom or both that know that there's a lot of opportunity there, because there is a lot of opportunity there.
Yeah.
And it's very exciting. So there are, we do know some people that may be able to make markets in those places. And if we have that, then we can have a product. So it is a possibility.
Interesting. I've always thought that it would be a better fit for some kind of alternative investment structure through like a limited partnership, so that you just don't have it just gives you more flexibility to get around the trading restrictions.
Yeah, no, that's definitely another possibility. But, in the ETF space, we do need that tradability. So
yeah, absolutely.
If it's a private fund, then you're good. And really, that you can do today, so if you have the structure in place. So,
yeah.
Yeah.
Oh, I had one more question about FRDM that I forgot to ask too. How do you handle currencies? Do you hedge the currency exposure back to the US dollar?
We don't hedge. So you do have all the currency risk of all these markets. That being said, the freer emerging markets are the ones that have lowest currency risk and also lowest historical inflation. So,
Right.
Yeah.
Right. Interesting. Okay, cool. Well, this has been great, Perth. I appreciate you joining me and answering all these probably mundane to you questions, but just this life cycle of having an idea of some kind of investment methodology and going from idea to launching an ETF is just super interesting. Not to mention the fact that I really like the way that you frame this. You weren't trying to do something huge and grandiose where maybe you make a lot of money eventually, but you felt like the idea had to exist somewhere, and you pushed through a lot of these barriers and challenges along the way because you felt like this just had to be out there. And that kind of entrepreneurial spirit is very common amongst our client base, and it's something that I share personally. And it's enlightening to hear your story and how it's come to fruition for you.
Thank you. And I so appreciate your support along the way too, Grant.
Where can people learn more about the investment company and about the ETF? Where should we direct people who are listening?
Yeah, so the ETF is, as you said, ticker FRDM. So you can look that up anywhere you do your ETF research. The website for the fund is freedomETFs.com.
FreedomETFs.com, FRDM. All right, Perth Tolle, thank you very much for being here. I really enjoyed the discussion.
Thanks for having me.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.